Hi guys, we are Group 19. Our project is about money market, consists of 4 parts: background, money market funds, example, and money market compared with capital market. The money market is a segment of a financial market in which financial instruments with high liquidity and very short maturities are traded. The money market is used by participants as a means of borrowing and lending in the short term, from several days to just under a year. If you want to understand the money market, you have to understand its 3 features: high liquidity, short-term trading, and low transaction risk. The result of high liquidity is greatly improved efficiency of money utilization. The same amount of money will not be limited to the time, place, and person. Earlier, sum of money lent amounts to a person, but in fact, the borrower just wants to use only 10 days. During this time, there are 20 days are wasted. In the money market, by trading intermediary, they can use the same money give to the right person at the right time. This money can help more people who really need it. Whenever a bear market comes along, investors realize the stock market is a risky place for their savings. It's a fact we tend to forget while enjoying the returns of the bull market. Unfortunately, this is a part of the risk-return trade-off. To get higher returns, you have to take on a higher level of risk. For many investors, a volatile market is too much to stomach. The money market offers an alternative to these high-risk investments, while short-term trading not only to help improve liquidity, but also help reduce the risk. About the history of money market, when there are parties that had surplus funds, while others needed cash. European money market appears very interesting. The earliest European money market appeared in 1950s. In 1957, because of Cold War, the Soviet Union government feared the United States government to freeze their dollar reserves, so all dollar reserves are transferred to London, that is Eurodollar. After years of development of money market, more and more completed in the present, there are discount market, negotiable certificates of deposit market, short-term security market, and interbank market.
Let's discuss the money market funds. Perhaps the most common form of bond investing involves a class of mutual funds known as money market funds. This investment vehicle must by law be both safe and liquid. The funds consist of cash and cash equivalents, highly rated debit issues that mature in less than 1 year. An investment whose objective is to earn interest for shareholders while maintaining a net asset value of $1 per share. There are 2 classifications of money market funds that dominate the market: the retail money market fund and the institutional money market fund. Retail money market accounts are marketed to high net worth investors. These funds are managed by brokerage house and are used to park cash while investors plan their next move. These retail funds make up roughly 40% of all money market assets. The largest player in this space is Fidelity Investments Cash Reserve Funds, with some 110 billion in assets. The second is institutional money market funds, are marketed to large corporations, government agencies, and other large entities. Cash is often swept into the accounts through automatic trading program on nightly basis. The largest player in the space is JP Morgan Money Market Fund, which has more than 100 billion in assets. Why we invest in a money market fund? Money market funds offer the more conservative investor access to low-risk investment and can serve as a safe haven for investors' capital during time of volatile market performance. For an investor who is looking for a short-term safe haven for their investments, a money market fund can provide protection against the volatility of markets. These funds are low risk and generate their returns through interest income derived from investment in a variety of money market instruments. As a return are generated through interest income, money market funds also allow individual investors to benefit from the tax exemptions available for interest income. So that is the introduction to the money market funds.
Okay, there's an example about money market. The government usually implements monetary policy to influence money market and domestic economy. The Philippine Central Bank held overnight rate steady but cut interest rate on the money market tool, which is a special deposit account, a tool it used to control liquidity in the market. The bank had been steadily reducing the interest it pays on the account and absorbs liquidity, aiming to force money into the burden economy, support economic growth, and to encourage the bank to use their funds for more productive economic activities. We can see from the figures, SDA rates are barely half their level of 3 years ago, which comes with a downward trend in money market rates. The interest rate on SDA is 2% on April 2013, down from at least 3.5% at the start of that year. Although the cut haven't led to a significant outflow from SDAs, the rate reduced further and has helped weaken the pesos, paired yields on the treasury bonds, and lifted the Philippine stock market to record highs. Local currency has weakened to 41 pesos against the US dollar since the central bank began cutting the SDA rates. Many economists predict and warned overly aggressive easing could inflate the asset price bubble. There is a risk that moves to cut the SDA rate aggressively could spur banks and funds to channel money to other assets such as property, fueling a potential bubble increase inflation risk rather than productive sectors. On contrast, the central bank said a benign inflation outlook and robust domestic growth provide a scope for lower SDA rates. It said the adjustment is in line with the central bank's efforts to fine-tune its monetary policy instrument and conduct monetary operation with more flexibility while ensuring liquidity. However, the economic growth is lower than its expectation in 2014 due to two factors. One is a higher rate of unemployment, the other is large outflow of hot money. The foreign portfolio investment to Philippines, also known as hot money. Last year, following our improvement in U.S. economy, the U.S. Federal Reserve announced that it would cut its bond buying program. This signaled the interest rate would begin to raise. The announcement set off the series of events including foreign investment pulling out of their funds from Philippines and other emerging markets, the local stock market dropping. Data shows that inflows reached 360.9 million, while outflows were recorded around 455 million. By next year, those investments are seem to decline further to 2.1 billion. For Philippines, where interest rate has been at record lows that create fears and raising interest rate would affect investment and consumer spending. The central bank is aware of potentially destabilizing effects of speculative hot money flows and the Fed is ready to use more macroprudential measure to slow the inflows.
The shadow banking system is a term for the collection of non-banking financial intermediaries that provide services similar to traditional commercial banks. The financial intermediaries involved in facilitating the creation of credit across the global financial system, but whose members are not subject to regulatory oversight. The shadow banking system also refers to unregulated activities by regulated institutions. Shadow banking institutions generally serve as intermediaries comprised of non-depository between investors and borrowers, providing credit and capital for investors that conduct maturity, credit, and liquidity transformation without explicit access to central bank liquidity or public sector credit guarantees. It makes profit from fees and from the arbitrage in interest rates. Also, it is a participator in money market that provide money market funds. A wholesale basis transaction model, which means it differs from retail model of traditional commercial banks. Opaque deal making over the counter. Information are rarely disclosed. These derivatives tradings happen in the OTC market. Information disclosure system is not efficient. High leverage ratio, owing to the lack of adequate capital referring to commercial banks, more leverage to shadow banking system using financial leverage. Because shadow banking institutions don't receive traditional deposits like a depository bank, they have escaped most regulatory limits and laws imposed on the traditional banking system. Members are able to operate without being subject to regulatory oversight for unregulated activities. In China, shadow bankings are expanding even faster. For instance, they grew by 42% in 2012 alone. The big danger lies in China, where regulatory approach is happening on an alarming scale. Banks they are banned from expanding lending to certain industries and from lowering deposits by offering high returns. So they do both of these things indirectly through shadow banks of various sorts. The trust companies and other shadow institutions are particularly active in the politically sensitive real estate market. Informal money flows are a big reason why property prices continue to rise. Across China, money continues to flow into apartment blocks and shopping malls, since developers cannot borrow money from banks until they own the land. Many need to raise funds elsewhere, as they are willing to pay upwards of 10% for the privilege. That sort of return attracts lots of interest from those with a surplus to invest. The first problem is the market for the derivatives. The quantity of open derivatives amounts to trillions, and these positions are another source of short-term credit risk. So a need for sudden payouts could also prompt a run on financial institutions. Another problem is that ending those central bank guarantees isn't always easy. The European Central Bank has stamped a financial collapse for now, but only by lending large amounts to banks at 1% for a 3-year window. And yet the Eurozone has entered a recession. So it's unclear when troubled European banks can return to private capital markets. The central bank may end up taking over much of the allocation of capital.
When talking about money market, people may easily think about capital market. Actually, money market and capital markets are two of the most important components of financial market. A financial market is a market that brings buyers and sellers together to trade in financial assets such as stocks, bonds, commodities, and currencies. Money markets are used for a short-term basis, usually for assets up to 1 year. Conversely, capital markets are used for long-term assets. Capital markets include the equity market and debt market.
Together, the money market and the capital market comprise a large portion of financial market and are often used together to manage liquidity and risks for companies, governments, and individuals. There are both differences and similarities between capital and money markets. From the issuer or seller standpoint, both markets provide a necessary business function, maintaining adequate levels of funding. The goal for which sellers access each market varies depending on their liquidity needs and time horizon. Similarly, investors or buyers have unique reasons for going to each market. Capital markets offer high-risk investment while money markets offer safer assets and generally, investment returns are often correlated with level of risk. Let's take a brief look at the main characteristics of money market and capital market. Money markets are where short-term securities claims are issued and traded. Banks and business adjust their liquidity position by borrowing or lending for short term on the money market. All of instruments have characteristics very similar to money, high liquidity and low default risk. No explicit interest payment so that discount. And for capital markets are where longer-term securities are issued and traded. The purpose is to fund large investment projects that will take several years to produce a reasonable income. Capital market instruments are less marketable than money market instruments, and debt securities have varying default levels. Finally, let's take a further look at the financial instruments in each market. For money market, there are treasury notes, commercial paper, commercial bills, certificates of deposit, and for capital markets, there are common stock, corporate bonds, treasury bonds, and mortgage-backed securities. Well, that's the end of our project. Thank you for watching.